Chapter 19, we're going to talk about job order costing. So here are your learning objectives, and basically we're doing cost accounting, the basics of cost accounting at this point. So we are a manufacturing company that is producing a product, and we're determining how do we apply costs to the product that we are making. So in a job order costing system, each product is going to have a specific job order that's associated with it. And then as we apply costs to it, we're going to charge it to that specific job order. So again, they give you some examples. In a process costing system, it's like we're making the exact same product over and over again. So like, let's say it's Coke and we're making Diet Coke. It's kind of impossible to distinguish those in the system as they're running through the different various departments or processes. So that'll be process costing. So here we have an example of process costing. So oil refineries, paper producers. So again, like just reams and reams of copy paper. Chemical processors, food processors, like again, even think about like, potato chips or things like that. They're going to just be so many and they're the exact same and they're running through the various systems. So a job order cost system is going to record all of their manufacturing costs and again, code it to a specific job that they're working on. So the jobs are still going to run through like we had in our last introduction into managerial accounting course. They still run through work in process and then become a part of finished goods. And then once they're in finished goods, we sell them out to our customers and it becomes cost of goods sold. So the flow is still the same. So again, this is going back to that guitar that we had in the last chapter when we were introducing it. So again, the raw materials that are needed to produce the guitar are in our materials inventory. Once we put them out into the production process, they become a work in process. And then in that stage, there'll be direct labor. People will be touching them, making them, adding value to them. And then there'll be overhead. And once they're, and again, overhead is like the lighting, the insurance, the supervisor's salary, all those things. Then once they're completed, they go into our finished goods warehouse where we would sell them off. And then when they're sold, we charge cost of goods sold. So again, same flow. So then here again shows you though, now we're going to do it in a little more detail to say these are our specific job orders. And we're going to cost the products or what we use specifically to those job orders. So our materials, again, it's going to be that raw material that we use as we issue it out to a job. We're going to decrease it as it comes in from our suppliers. It's an increase. So we purchase the material, it increases our materials, and then as we issue it out to the job, it decreases it. So here they show you kind of examples of like, okay, so here that we have the general ledger account, materials coming in, then materials are going out through this material requisition, going to specific jobs. So job 71, job 72, and then we're going to go to the job cost sheets where we'll see that material go in, but then we'll also start to see the labor, and then overhead will eventually be applied to that as well. So we'll have receiving reports when the merchandise, or I'm sorry, not the merchandise, but the raw materials come in. And then we will make an entry to debit materials and then credit accounts payable when we get that bill, because again, we'll owe the vendor. Then as the people out on the production floor utilize those materials, they'll prepare material requisition that will then be charged to a specific job. And then we'll find the job cost sheets that will include all of those costs. So then here is the journal entry that needs to be made when we issue out those materials to a specific job. We will debit work in process and we will credit materials. So again, I'll let you read through those examples on your own. Then labor, so then now when it's out in the work in process, we have individuals who are responsible for making those products, and they will have time tickets. They will charge their time to a specific job. So notice here, they've got the job number right on their time ticket. And a lot of industries do that. I mean, even in accounting, we charge our our time to specific customers. So it's a similar scenario. So then they're going to total up the labor that was involved in that job, and that's going to go on to the job cost sheet in the form of labor. And then again, eventually we're going to allocate factory overhead to it. And then here is again that journal entry. So it also goes into work in process. And then now we would credit wages payable because we're going to owe those employees maybe every Friday or a week from Friday or whatever. And again, I'll let you look at those exercises. Then now we get into the factory overhead. So the factory overhead includes all of those other manufacturing costs. So like indirect materials that maybe we're like, you know, maybe we're using WD-40 in these products, we're using a whole bunch of screws or, you know, just things that we don't trace directly into the products, but those are more just used out on the production floor. Indirect labor, so again, not people who are touching the product and making it, but the people who are outside of that. So they're production supervisors, maintenance people, and then all of our electric bills and our gas bills and any depreciation of those equipments. All those things are going to be included in our factory overhead, property taxes on the plant, all that stuff. So then what we have here is again the journal entry. So it goes into factory overhead when we use these various materials, the indirect materials, the indirect labor, our utilities, our accumulated depreciation. Those will value into our factory overhead. And again, here's an example. Now then what we do though is once we get all that overhead in there, we allocate it out to the specific job, because again, like the janitor's salary can't be tied to a specific job. We have to allocate it. So then how do we allocate it is we come up with an activity base. So we say what activity increases the use of these like indirect labor or indirect materials. So it could be direct labor hour, could be direct labor cost, could be machine hours. Again, what do you think makes these expenses go up? So we'll come up with our estimated total factory overhead costs, and we will divide it by whatever we think that activity base is to come up with a predetermined overhead rate. And when we do these problems, they'll tell us what that activity base is. So here's an example. If we had $50,000 of estimated overhead and we're going to base it on direct labor hour, we estimate that there'll be 10,000 direct labor hours. We're going to charge out the overhead at $5 per direct labor hour. So then when we do it very precisely, it is activity-based costing. So then we may have it based on the different activities. So maybe inspecting, there's different costs associated with it, moving the inventory or the product, machining. So those can get into more specifics of how we do it. But here we go back to our job cost sheets. We've already calculated our direct materials through those material requisitions, our direct labor through the time ticket. Now, if we're basing it, our overhead allocation on the direct labor hour, again, it was that $5 rate, we will look at how many hours did we apply to this particular job 71, 350 hours. So that times our $5 allocation rate is how we'll allocate the overhead. So again, we do that for each job. Now we have all three components of product cost: direct materials, direct labor, and overhead, and they've all been charged to the job. So again, here that shows it worked out. And then our journal entry, we debit our work in process, and then we credit our factory overhead. So our factory overhead, we debited it when we had all the costs coming in. Now we're going to credit it and actually apply it to the jobs. And then there'll be times where then we're going to look at that, because again, they're going into that same account. We could be over applied or under applied. So we're going to look at that actual compared to the applied to see how close we are. So if we're under applied, it means we've applied less than we actually incurred. If we're over applied, it means we applied more than we actually incurred. So we would want to adjust that. And then here, like here, it shows you what was allocated and what was incurred. So what was applied and what was incurred. And we would have an under applied balance and then an over applied balance. We're going to want to correct those and get them out of that account. And then I think we charge it off to cost of goods sold. So here we'll get into that though. So then here we have, if we have a balance in that factory overhead account at the end of the year, we don't want to carry it to next year because it's not like it goes on into next year. So it depends on which way it goes. Again, here they show you if you're under applied or over applied, but basically you want to look at that factory overhead account and see what do you need to make that go down to zero, because we want to zero that out at the end of the year. And then we'll either debit cost of goods sold or credit cost of goods sold. So when we're dealing with the under or over applied, the offset account is always cost of goods sold. So again, looking at the overall work in process, we've got direct materials that were charged to it, direct labor charged to it, and then we applied the factory overhead to it. So then here they show us, and it's all coming in to that same account. So we have the direct materials, the direct labor, and our factory overhead. And then when we complete the job, we're going to credit out of it work in process, and then it's going to end up going into finished goods. So we credit out work in process, we debit finished goods because that job is completed and transferred into finished goods. If it's not yet completed and it stays, so job 72 is not yet completed, it'll stay in our work in process inventory and again until it is done. So I'll let you look at that. Then once it goes over into finished goods, then we're going to sell it out of there. So we could look to say, okay, what do we have? And then what was shipped. So we manufactured 20 units from job 71, and then we shipped out 40 from the ship order 643. And then we break it down over here into unit costs associated with those finished goods. And then as we sell it, so we sell 40 of these guitars for $850. So that's a $34,000 sale. We're going to charge off the sale to cost of goods sold, charge it to our accounts receivable because we're billing out our customer, credit our sales because we're recording our sales. But then we want to do that second entry where we charge it to cost of goods sold and take it out of the finished goods warehouse. But again, that we want to go back and do it at our cost. So again, looking up here, we're selling it at a selling price of $850. It cost us $500. So there's always that difference, that markup between what did it cost us to make it and then what are we selling it for. Period costs, again, we talked about in our last chapter. Those are always expensed as they're incurred. We don't charge them to the product. They just end up on our income statement. So our general and administrative expenses and our selling expenses are good examples of period costs. And again, those are just expensed as they're incurred. So here kind of shows you a big flow if you like to kind of look at those types of, like T account flows, how everything goes in. So again, we've got our materials, our overhead, and our labor, our wages payable. So all those are funneling into our work in process. Our work in process then goes into finished goods. Finished goods are sold into cost of goods sold. And then again, it's showing you, but kind of by job or more detailed down below how that goes in. So then here's an income statement, again, set up as we always do. It's just showing how we calculated out that cost of goods sold number. And then, so our job order costing, again, accumulates it by job. And again, we're looking at actuals versus what we're allocating. So again, here gives you the job 54. We made these 40 jazz guitars. what material went into it, and what that price was. And then we've got this other one, again, just kind of mapping out the different prices in there. So when we're using our decision making, though, we may look at it to say, okay, well, how come we used so much more materials for this job over the other job? So again, it could help management determine, do people need to be trained better? Was the material poor quality? So those are things, again, they're going to look at to say, well, should I make some changes in there? And like I had said in the one, like job, like when we're allocating our time, even services business, they allocate their time to specific customers or specific clients. That's how we bill them out. So that would be very similar in that, except for you don't necessarily have direct materials. You would have direct labor, and then you would probably have indirect materials that you would use as part of those service businesses. So again, they'll show you the flow costs. So just a little less detail, and you don't have direct materials, you would have supplies. Okay, so that is our costing.